They just pulled the plug on the global silver market, and the two-word excuse they gave should be an insult to your intelligence. While silver was staging a massive $5 vertical rip toward $95 and the first notice day deadline arrived, the CME group went dark for 90 minutes, citing a technical issue that conveniently froze the world's most powerful metals exchange at the exact moment the paper market hit a physical wall. We are currently witnessing a 4-to-1 gap between paper promises and physical bars, with silver draining out of COMEX vaults at a rate of 785,000 ounces every single day. The glitch didn't stop the signal, it only proved the desperation. Today we are breaking down why the $94.50 recovery is the beginning of a massive institutional short squeeze that is about to collide with a $385 billion demand shock arriving in exactly 33 days. It's Saturday, February 28th, New York time, and while the trading floors are empty, the numbers from yesterday's session are still sending shockwaves through the system. Drop your date and city in the comments. I want to see who's awake for the fallout of this 90-minute blackout. If you're here for the data the mainstream media is too scared to touch, hit subscribe and drop George Williams below. It's the only way to stay independent of the algorithms. Let's get into it because there is a lot to unpack, and every single piece connects to the next. Silver traded at $92.06 per ounce as of Friday morning, a nearly $5 jump in a single 24-hour window, and more than $60 above where it was trading just 1 year ago. Fortune, that is not a normal move. That is the market telling you something urgent. And if you look at where silver was just a few weeks ago, bouncing in the mid-80s range, trying to find its footing after the historic volatility of January, silver broke through the record $100 per ounce milestone back in January, then pulled back sharply. CBS News. What we're watching right now is a reacceleration. The market is making another attempt at those highs, and this time, it has 3 enormous catalysts at its back simultaneously. You don't get that kind of alignment often. The gold-to-silver ratio currently sits at approximately 57.6, with gold trading around $5,209 per ounce. Mine listings. That ratio number is critical. Here's what it means in plain language. It takes roughly 57 ounces of silver to buy 1 ounce of gold. Historically, that ratio has averaged somewhere between 60 and 75 over the long run. When it compresses below that range, as it's doing right now, it's telling you that silver is outrunning gold, that investors and industrial buyers are flooding into silver specifically, not just precious metals broadly. Silver hit an all-time high of $121.64 in January 2026, then corrected sharply before staging this current recovery toward the low 90s. Mine listings. The structure of this market is still wildly bullish. You had a speculative blowoff, a brutal shakeout, and now you have a fundamentally driven recovery with real-world reasons behind every dollar of upside. The COMEX silver inventory stands at approximately 98 million ounces, alarmingly low given outstanding March futures contracts totaling over 400 million ounces, with withdrawals averaging 785,000 ounces per day. Mine listings. Think about what that means. The physical silver being pulled out of the system is not keeping pace with the paper obligations being made against it. That's a supply tension story that doesn't resolve overnight, and it's one reason institutional money has been reluctant to aggressively short this market. The squeeze risk is real. Now let's talk about the inflation data that hit the market on Friday morning, because this was the first detonation in what became a 3-charge explosion for silver. The producer price index rose 0.5% in January, the sharpest monthly gain since September, after a revised 0.4% increase in December, well above what forecasters had expected. Bloomberg. The services component of the index surged 0.8%, driven by rising logistical costs and a rebound in energy-related inputs. On a year-over-year basis, headline PPI now sits at 2.9%, its highest level since mid-2025. Financial content core PPI, which strips out food and energy to give you the underlying trend, came in at 3.6% year-over-year, significantly higher than the anticipated 3.0%. Hoka News. Here's why this matters so much for silver specifically. The PPI is what producers pay before those costs get passed to consumers. Think of it as the pipeline. When wholesale prices are running hot like this, the consumer price index, the number everyday people feel in their grocery bills and utility costs, tends to follow with a lag of 3 to 6 months. The Federal Reserve knows this. Any hope for a rate cut in the first half of 2026 has effectively evaporated, and the market is now pricing in only 1 or 2 cuts for the entirety of 2026. Financial content. That is a dramatic shift in expectations, and precious metals respond to it immediately. Here's the chain reaction. Hot PPI data means the Fed stays on hold. Fed on hold means real interest rates remain under pressure as inflation eats into the value of yield. Negative real rates, where your return on cash or bonds can't keep up with inflation, are the single most powerful structural tailwind for precious metals. This is not speculation. It's the same dynamic that drove silver from $15 to $30 in the aftermath of 2020, and it's the same dynamic that has pushed silver up more than 160% over the past year. Silver jumped 4% on Friday alone as gold cleared $5,200, with markets adjusting to stubborn price pressures, geopolitical risk, and a growing rotation away from high-flying growth stocks. Gold-silver. That simultaneous move, silver up sharply as tech gets punished, is smart money repositioning in real time. Now let's layer in the geopolitical dimension, because this is where the story gets genuinely frightening, and where silver's role shifts from inflation hedge to something even more urgent. Iran and the United States held hours of indirect negotiations Thursday over Tehran's nuclear program, but walked away without a deal, leaving the danger of another Mideast war on the table, as the U.S. has gathered a massive fleet of aircraft and warships in the region. NPR. These weren't casual diplomatic exchanges. U.S. and Iranian officials conducted one of their most intense rounds of negotiations in Geneva, but failed to reach a deal. Time. The sticking points are fundamental, and they are not going away. The U.S. is pressuring Tehran to dismantle its ballistic missile development program and destroy the 3 main nuclear sites at Fordo, Natanz, and Isfahan, while Iran has insisted on its right to carry out uranium enrichment inside the country. CNBC. Those 2 positions are not compatible. One side would have to blink entirely for a deal to happen, and neither has shown any sign of doing so. Trump told reporters Friday he was not happy with the fact that they are not willing to give us what we have to have. Time Witkoff and Kushner reportedly told Trump that it will be difficult, if not impossible, to reach a deal with Iran. Wikipedia. Meanwhile, the USS Gerald R. Ford aircraft carrier departed Suda Bay in Crete, heading for the coast of Israel, leading a second U.S. carrier strike group to take up positions against Iran. Al Jazeera. When the United States is moving 2 carrier strike groups into position simultaneously, the diplomatic window is not wide open, it's closing. If America attacks, Iran has said U.S. military bases in the region would be considered legitimate targets, putting tens of thousands of American service members at risk. Iran has also threatened to attack Israel, meaning a broader regional war could erupt across the Middle East. The Reporter. The U.S. Embassy in Israel urged staff who want to leave to depart, while Australia told families of its diplomats in Israel and Lebanon to leave both countries, citing a deteriorating security situation. Pravda nations don't evacuate diplomatic families for theatrical effect. When embassies start moving people out, they're operating on intelligence the public doesn't have access to. Now understand what this means for silver beyond the panic buying. Silver is not just a monetary metal. It is a critical defense technology metal. Every guided missile system, every advanced radar array, every communication network running through military aircraft uses silver. Defense spending is surging globally, and conflict in the Middle East doesn't reduce that, it accelerates it. The silver market is in its 6th consecutive year of a structural supply deficit, driven by industrial demand from solar energy, electronics, and increasingly defense applications. Mine listings. You cannot print more silver. You cannot warehouse manage your way out of a 6-year deficit. When geopolitical demand stacks on top of industrial demand, on top of monetary demand, the supply-demand equation becomes almost impossible to resolve at current price levels. The dollar itself deserves attention here. Safe haven demand has been fueled by a rotation away from dollar-denominated assets amid growing concerns over policy uncertainties in Washington. Trading economics. Normally, rising geopolitical risk sends investors into dollars. But we're in an unusual environment where investors are questioning dollar dominance itself. Tariff uncertainty, fiscal deficit expansion, and political unpredictability are all pushing capital into alternatives, including precious metals. Recent U.S. trade policy, including a 15% blanket import levy, has softened the dollar index, leading to increased capital flow into bullion as a safe haven asset. Mine listings. A weaker dollar is jet fuel for silver priced in dollars. Every 1% move lower in the DXY can translate into meaningful upside for silver, all else being equal. So let's talk about where this market could go from here. And let's be honest and specific about all three scenarios. The first scenario is a continuation rally toward the $100–110 range. This is the base case if diplomatic talks in Vienna fail to produce meaningful progress next week, and the US maintains its military posture in the region. Silver broke out this week from the $86 to $88 consolidation band that had formed over the prior 3 weeks. Technical analysts watching silver on the weekly chart see that breakout as significant. It means the prior support has flipped to a launchpad. Algorithmic forecasts are projecting silver reaching approximately $92 by early March, COMEX. But if geopolitical risk escalates into any form of kinetic action, strikes, retaliation, or blockade, those forecasts would be conservative almost immediately. Institutional money that's been sitting on the sidelines after the January blowoff would come flooding back, and with COMEX inventories as thin as they are, that demand pressure has nowhere to go but price. The second scenario is a pullback and retest, potentially back toward $83 to $86. This happens if the Vienna technical talks produce a surprise framework, not a full deal, but enough diplomatic language to lower the temperature. A de-escalation signal from either the US or Iran would trigger profit-taking across precious metals. Pair that with a hotter-than-expected PCE reading in mid-March that forces the market to price in 0 rate cuts for 2026, and you could see the dollar strengthen enough to push silver back toward that support zone. This would not be a trend reversal. It would be a healthy correction in an ongoing bull market. But it would be a painful 2 or 3 weeks for anyone who bought the Friday surge without managing their risk. The third scenario is the one that keeps experienced market participants up at night. Military escalation that disrupts Middle Eastern supply chains, spikes oil prices above $90, and sends inflation expectations into a completely new regime. In that environment, silver would not be trading at $94 or even $110. We'd be having a very different conversation. Analysts have warned that any military clash in the region could unleash turmoil in the wider Middle East and for oil markets, with broader energy supply risks if hostilities escalate beyond targeted strikes. CNBC. Silver has historically outperformed gold in the early stages of inflationary shocks because investors rush to both the monetary hedge and the industrial hedge simultaneously. If oil goes to $90 and PPI data in March confirms that producers are passing energy costs aggressively through the supply chain, the Fed's hands are even more tied. And every month that rate cuts get delayed is another month that capital has to find a home somewhere other than cash. Here's the conclusion, and I want you to sit with this for a moment. Silver has been the honest metal throughout human history, not the glamorous one, not the one that gets the headlines, but the one that shows up when everything else is falling apart. Right now, it is receiving signals from 3 separate directions simultaneously. An inflation system that refuses to cool down no matter how much the Fed wishes it would. A geopolitical situation in the Middle East that is one failed negotiation away from becoming a regional war. And a physical supply deficit that has been building quietly for 6 straight years. When those 3 forces converge on an asset with this kind of industrial importance, an asset that goes into solar panels, semiconductors, medical devices, weapons systems, and the entire digital infrastructure of modern civilization, the market's job is to find a price that rations that scarcity. We may not know exactly where that price is, but based on everything the data is telling us right now, it is almost certainly higher than where we are today. Watch Vienna next week. Watch the PCE data on March 13th. Watch the second carrier strike group. Silver will be watching too.